Okay, well, good morning, everyone. Luke Mandekic from Channel Capital here. Thanks for joining us this morning. I think everyone's still sort of logging in, but I'll kick off with a short intro and we can get stuck straight into things. So I think that the last webinar that we had with Redwheel was back in March, and that was really not long after the onset of the war in the Ukraine. So, a lot of the discussion was inevitably focused on the situation in Europe at that time. And I mean, sadly, with the conflict sort of still raging now, some sort of 6 months later, I'm sure that's going to be a significant point of discussion again today. But outside of Europe, it's been a super volatile year, to say the least. Inflation remains at the forefront of probably everyone's mind, not least policymakers and market participants. Geopolitics have continued to throw curveballs. China is confusing almost everyone, and volatility has been pretty extended across commodity markets. Underlying all of that, valuations are also reaching some pretty interesting levels. So yeah, there's a lot to unpack and dig into today. I'm pleased to be joined once again by John Malloy, live from Miami. I'm sure it's a lot warmer than the 9 degrees we've currently got in Melbourne over there, John. For those that haven't met him yet, John co-heads the emerging and frontier markets team at Redwheel. He's been covering emerging markets for more than 25 years. Fair to say he's seen a few crises in his time. Importantly, I always like to remind people of this, but over his career, John's managed EM debt portfolios. He's managed long-short EM portfolios, as well as the traditional long-only strategy that you're all familiar with on the call. So he does bring a very unique perspective to the asset class, which I think is quite important, especially at times like this. In terms of the order of proceedings for today, so John's prepared some slides which touch on some of the key themes and factors that the team are currently watching. So John will walk us through some of those, and then we'll move into a Q&A. And just a reminder to everyone on the call, you can submit your questions at any time. And we've already had a few come through prior to the call, which is good to see. So keep them coming. We'll get through as many as we can. Okay, so on that note, welcome, John, and I'll hand over to you.
Great. Well, thank you very much, Luke. Thanks, channel, for having me. Thanks, everyone, for joining. Hope everyone's doing well and starting to move on beyond COVID at this point. Just at a high level, I have some charts that we used during the last quarter and recently. Some of them might be repetitive and some of the themes we've been talking about for some time, but these are pretty long-term themes, so I'm going to kind of stick with them because I think we still have a ways to go. A few areas that we hit on are, one, looking at emerging markets, how they're positioned now in terms of the macro, how they're set up to recover, coming through COVID, coming through this rate cycle. Commodities, which, as you know, emerging markets tend to be major beneficiaries of commodities. And then look at growth kind of across emerging markets, because I think as we start to move towards 2023, the question is going to be, where do we find growth? And there's a debate in the U.S., but we've had 2 quarters of negative growth, and in my history in economics, that typically is a recession. So maybe we're not in an exact recession, but we're in a slow growth environment in the U.S., in Europe. And if you look at emerging markets, actually some of the markets are offering pretty good growth, and I think you're going to see going into 23 that the growth differential in terms of economic growth, and it's going to basically flow down into revenue and earnings growth, is much better for EM. So just hitting on rates, I mean, as many of you know, emerging market central banks started to tighten monetary policy almost as far back as a year and a half ago. The Brazilian central bank tightened. We've had tightening throughout the emerging market complex. You've had even China keep rates at a very, very high level. If we look at places like Brazil, rates are now, overnight rates are 13, 14%. If you look at places like South Africa, the 10 years north of 10%. So monetary policy has been tight for quite some time in emerging markets. As you know, the Fed's in the middle of a tightening cycle, and the ECB really just started almost a few weeks ago. So they have a ways to go. Now, it's also interesting to note, and as Luke mentioned, I've been through multiple emerging market crises, and I think it's super interesting that we're here today where everybody knows the dollar is expensive, everybody knows rates are going up, but you look at reserve growth in terms of central banks has been very strong throughout the emerging market universe. This is pretty unusual. Typically, you see capital flight, which means central banks draw down reserves. Now, you have a little bit of outflow in Brazil, but that's tiny compared to their reserve position. Additionally, if you look at current account balances, I mean, for the most part, especially in the larger emerging markets, so Taiwan, Korea, China, Mexico, even India, are in a really good position. There are a couple smaller markets that are in a difficult position, but even a place like Chile, that's going to basically start to recover as you see commodities come back. And clearly lithium, which is something we're going to talk about, has a big impact there. So the reserve position, the current account, actually is really very, very favorable. Now let's look at where those economies are coming through the COVID crisis. I mean, basically, many of these very large economies still are well below potential growth, which means that they can have non-inflationary growth. They can have non-inflationary pricing pressures as they recover. Now, this is really different from where we are in the US, where we're well above potential growth. Even parts of Europe were well above potential growth, which has resulted in higher inflation, and we're seeing that to be a problem. But emerging markets, and with the largest being China, I mean, China really hasn't had these inflationary pressures that we've seen in developed markets. Let's move ahead to commodities, and we'll go back to some of the macro in the Q&A, I'm sure. But we believe that we are in an energy transition that will require a tremendous amount of commodities going forward. And even if you go back 2, 3, 4 years ago, it's completely different now in terms of the total focus on energy transition. Before it was centrally Europe, now it's basically all large economies are focusing on the green agenda. Companies, corporates are focused on investing in renewables. Consumers are looking at products to buy, with EVs probably being the largest one, but also solar and wind and whatnot. So the fact is, though, we need more commodities. We need a lot more copper. We need to almost double the copper production in the next 30 years or so, which is remarkable because even over the past few years, it's very rare that we actually have positive supply growth. And if you look at the supply demand dynamics right now, we continue to have very, very tight market, and I'll get into that later. Lithium's off the chart. The lithium price, as many of you have seen, has been very, very strong. That's resulted in the stocks doing well. And so we're basically in a new paradigm in terms of lithium. Even steel, which you could argue, with the overcapacity of steel in the global market in China, for example, but we still will need more steel and aluminum, which again is positive for commodity producers. It's positive for even countries like Australia, of course. Now look at China, look at where we are in terms of copper, and I think this is really pretty amazing. This is China visibility in terms of inventories. The red line here is where we are today in terms of copper. We're at the lowest level that we've been in years. This is at a time when the Chinese economy is slow and weakening. So at a time when people are worried about the Chinese real estate property market coming down. So something's going on. And what's basically going on is that there's a tremendous amount of copper demand from other areas, such as the electricity grid network, electric vehicles consuming 5 to 7 times more copper. You have companies even just building out things like solar, wind require much, much more copper. So we continue to be very bullish on copper. 40% of the world's copper comes from Chile or Peru. Both of those countries have recently elected leftist presidents, although they're moving to the center. So the marketplace for copper definitely continues to be interesting. We just saw BHP bid for Oz Minerals. That was at a multiple of 9 to 10 times EV/EBITDA. That's a huge multiple, much greater multiple than the stocks that we own, like First Quantum or Ivanhoe. So clearly, a company like BHP doesn't see copper being at 350 or even maybe 375 for long. They clearly see the forward price of copper going up, which again, this is very different from where we were a few years ago. If we look at lithium, again, with if you look at the spot market has been very strong. Demand's been very strong, and you're really just starting to see, some of the majors come out with their EV lineups right now this year. I mean, it was obviously Tesla's been in the market for some time, but every car company across the board, including Ford, having their Ford F-150 Lightning, are coming out with EVs. That just means more and more demand for lithium. The other demand driver, though, is energy storage. And when you look at energy storage in terms of around systems like wind, solar, that's another driver. So we see this market being really out of balance for some time, which again, it's a great opportunity for our investments like SQM, Sokimich, which is the Chilean lithium producer. Now, even aluminum, and if we look at aluminum, which the inventories are down to a very tight level. Although the price of aluminum has corrected, recently as people have feared recession, we think that that's going to be short-lived. I mean, if you look at the capacity remains really tight, inventories remain low. And so when we look at just another driver in terms of the investment into renewable spending, whether it be, again, wind, solar, EVs, they consume quite a bit of aluminum. Now, China and China growth, that's a big debate these days. And, we can get into that in the Q&A in terms of their economy, but we actually have a pretty favorable view on China at this point. And we think that the growth is bottoming probably in this quarter, the third quarter, and will start to recover in the fourth quarter and into next year. Our economist, Chairman Felipe, probably see 4.5%, maybe even increasing to 5%, which, that is a very different view than the market. We are seeing signs of that growth kind of coming through, and we saw some companies, we saw PDD, for example, which I'll talk about later, come through with strong numbers. Not only some of the e-commerce companies, automotive sales have been strong recently. Secondary sales of homes have been strong. So you're starting to see high frequency data coming through in China that supports a recovery. Now, EV is obviously an area that has tremendous growth, and we've been talking about it for some time, but we still think that we're in the early phases here. And within China, we're not only investing in the OEMs, companies like Li Auto, the Tesla-like companies of the world, but you're also basically able to invest in the battery components, the materials, as I mentioned, lithium, copper, the battery makers. So we're basically able to invest in the entire supply chain. As you probably know, China is the world's largest automotive market. They're also the largest EV market in the world. The EV growth we're expecting to see over the next few years is upwards to 50 to 100%. So very strong growth for an extended period of time. And you can see, as they roll out renewable, that wind, and if you look at offshore wind, if you look at solar, it's now at this point very competitive in terms of coal. So we're below the cost curve in terms of coal, which means that there's more spending on new capacity, new solar capacity. We actually own China Resource Holding, which is traditionally it was a coal company. Now basically it's moving towards wind, and the next phase will be more towards solar. So you have these companies that are traditional kind of coal burning electric utilities that are now spending billions and billions of dollars to transition towards wind and solar. If you look at the internet, I mean, we had a massive growth correction in internet stocks globally, but also especially in China. And some of you who have been following us for some time might remember that we did sell Alibaba in November of 2021. That was basically when Ant Financial, when the deal was canceled, when you basically had, actually 2020, excuse me, when you had the deal canceled, when you had basically the beginning of the regulatory clampdown. And that's when you had a enormous correction in these stocks. The values came down. But if you look at some of the stocks, I mean, China is a market where technology companies are disrupting other technology companies, and PDD, Pinduoduo, would be a good example. JD would be a good example in terms of the e-commerce space. You have other companies like Kuaishou that are moving into e-commerce, that are also in the short video clip business. And so we think that, you know, where the values, given the values and where they are, we're still finding opportunities of 20 to 30, maybe even 40% growers when we look at that market. It's a deep market. It's a very fragmented market. It's a fast changing market. And we think that will continue to be interesting for some time. PDD, Pinduoduo, which is the company I mentioned before, they are e-commerce. They're basically moving into, you know, food to farm directly, so cutting out intermediaries. They basically have this community purchasing model where you buy bulk and you basically buy directly from the manufacturer and at a very deep discounted price. The stock was up 15% on the earnings release yesterday. They put out amazing top line growth at just shy of 40%. Their operating income was up. They're profitable. They're very profitable. Their operating income was up 300% year over year. And so you can see, I mean, this business, which is a relatively new business, it didn't exist really much more than 6 years ago, is now $73 billion, but also trades at 27 times earnings. We think it's probably, you know, a mid 30% grower for the foreseeable future. So even at 27 times earnings, it still offers really very good value. Now, Latin America is interesting because Latin America is really a pure beneficiary of commodities. 50% of the exports are commodities. And we think that this chart is very interesting because it illustrates basically how Latin America did during the last commodity bull market, which was from about 01 to 07, 08. The market was up enormously. And just to remind you, this was at a time when Lula was in power, the candidate who's running for president today. It was at a time when, you know, Brazil also had, you know, a lot of market inefficiency, market problems. So this was at a difficult time. And I would argue that Brazil's in a much better place right now in terms of its competitiveness, in terms of the banking system, in terms of the industrialization. So our view really is that we are setting up for an extended commodity cycle. And we do believe that you could see markets like Latin America, Brazil, Chile, the Andean region, even Mexico do well for an extended period of time. The market's cheap. Now, this is, again, very unusual to see the market this cheap at this time. I mean, basically, the market's valued as we were in 08, 09. 08, 09 was completely different from where we are today. I mean, we're talking about a financial meltdown in the US, most of Europe. The markets were in very distressed situations. So we think that the market opportunity, again, you have the valuations are setting up, the growth is picking up, commodities are looking good, and we're coming off of a rate cycle. The Central Bank of Brazil 2 weeks ago announced that they'll likely see a rate reduction in the next meeting. So they're done. Their monetary cycle is done, whereas the Fed, you know, we continue to hike, Europe as well. Mercado Libre is another one of our core holdings at this point. Mercado Libre, you know, we owned it. You could see this big run up in the chart. We actually increased the position during COVID, during that sell-off. It was one of our top positions. It ran up, hit our price target. We sold it up here. And this year, just recently, over the past couple of months, we've bought back into the position and built a pretty core top 10 position in Mercado Libre. The company reported numbers 2 weeks ago. The stock was up think it was up close to 20% on the day and continued to do well. If you look at the results, they were very strong, kind of across the board. Their e-commerce business has been doing well. Their payments business and their banking, their fintech business is doing really well. But what we like about Mercado Libre is that we have a long runway for growth. I mean, we have 8.3% penetration rates. I mean, these penetration rates could double or maybe even triple over the next few years. You also have, Mercado Libre in the last quarter, they attracted 41 million unique users in their e-commerce. That grew 100% from 3 years ago, from pre-COVID. So, but it's still only 41 million. If you look at Latin America, the total population of Latin America is about 500 million. So we still have a long way to go in terms of e-commerce, and clearly payments is much further behind that. Now, just finally, I'll mention GCC, because this is one where I think, many of our competitors are probably not focused on. Saudi is now one of the larger emerging markets. Saudi was not an emerging market even, a few years ago. If you look at recent surveys in terms of, confidence in their government's confidence in growth, Saudi actually ranks very, very high. People in Saudi are very favorable about the direction of the government, the diversification. The government's investing a lot of money outside of oil and gas into building out new cities, building out new infrastructure, but they're also building out new industries that they've largely ignored. And one of them is materials. This is Ma'aden, which is one of the largest aluminum producers in the world, but also has the potential to explore gold, precious metals, maybe even copper. So again, this is an opportunity, 50 billion market cap company that probably many of our competitors haven't met with the management. I've met with the CEO. I met with him in South Africa earlier this year. We visited the company. We'll be going back to Dubai in the next month or so, and we'll meet with them again. So there continues to be, a tremendous amount of kind of off the run growth stories that are very large and scalable, throughout EM. So why don't we stop it there, and I'll hand it back to you, Luke.
Great, thanks for that, John. So we've got quite a few questions that have come through, and not surprisingly, a lot of them are focusing on China. So that's probably a good place to start. There's a few questions around China's zero COVID policy. So maybe we'll start there. What is the latest on the zero COVID policy? Is it sustainable? Are you expecting a softening in the stance on that front? And how does that sort of correlate with your expectations around China bottoming this quarter if they do continue to have outbreaks? It seems like they will. I think there was another announcement out of Shenzhen overnight around further clampdowns due to an outbreak. So it'd be interesting to get your thoughts on that.
Yeah, I think one thing to think about is, why are they having a zero COVID policy and who's having it? And really, the zero COVID policy has been driven by Xi. As we all know, Xi has a very important party meeting this October, November. They haven't announced the date, but where he will stay in power for longer. So going into that, there was a potential for them to have a massive COVID outbreak going back a couple months ago. If this were to happen, it would have been a disaster. The health system in China could not have handled it. So you literally, he would be going into these meetings with a health crisis, with people dying and millions of people potentially dying. So, I think what they did at the time was they decided, all right, we're just going to have to lock it down. They saw what was happening in Shanghai. At this point, it's been largely controlled. As you probably hear from people, there's testing all the time. There's testing stations, there's tracking, there's monitoring. And even on a daily basis, when you look at it, there might be 100, 150, 200, 300 cases a day in China. Now, China's, well over 1 billion people. So that's a very, very small amount. So they've done a very good job at controlling it. But our base case really is, once we get beyond the party meetings later on this year, that many of those restrictions are lifted. There's rumors that Xi will actually travel, and that some of the travel restrictions will be lifted into next year. You also see currently now. Mobility has increased. If we see businesses like restaurants, movies, things like that, that has started to pick up. So we're seeing signs of that. Our China team, we have 6 people in Chinese mainland analysts or portfolio managers sitting in Singapore who are talking to people, monitoring. So we are seeing it improving, and we actually think that the worst is over. So I think at this point, the headlines like you see out of Shenzhen are just that kind of headlines. And the other thing to note is that we're seeing policies that focus on recovery. So we're seeing an infrastructure program, $120 billion on infrastructure came out now a couple months ago. We're seeing the PBOC and the government work with banks on providing lending to property. We're seeing, the mortgage rates came down slightly. So you are seeing infrastructure as well. Now, you wouldn't be seeing those programs coming through as much as we've seen them if they completely wanted to lock down the economy.
Okay, that's interesting. So your views on China are largely predicated on an expectation that there will be some loosening in that stance around COVID policy, and that the government may be more tolerant of the case numbers going forward. Because
and I think that as we know in China, things tend to be opaque. So we might not know what the case numbers are going forward, but I think the key is that that's not going to be their policy driver. The policy driver going forward is not going to be zero COVID. The policy driver going into this meeting was that because of the risk. Going forward, it's going to be basically economic stability, common prosperity. If you look at the unemployment of youth, it's very, very high. So at some point, and we think we're close to that, where the government is really going to focus on economic growth, economic stability. You've seen them loosen up the renminbi to become more competitive. So they're competing against the strong dollar, of course. And so I think that's another sign that they're focused on recovery. And as we move closer to 23, I think that's going to be kind of the front and center. There's also been a lot more attention focused on the property market. It's not the entire property market. If you look at actually secondary home prices in major cities are going up. I mean, if this was a housing crisis, you would not see that. I mean, if you looked at 08, 09 in the US, the entire housing market crashed and home prices went down. And you're seeing actually transaction and demand for secondary properties in the major cities. So this is kind of an isolated event in terms of the Evergrandes of the world or the smaller developers that got in trouble. And now the government has really kind of focused on solving that problem, the whole, mortgage strike and whatnot.
Yeah, because I mean that's probably the other key area that we're getting a lot of questions around, and the things like the mortgage boycotts obviously grab a lot of headlines. There's been a lot of talk of property sales really sort of plummeting, new housing starts being really weak, and the fact that the property sector has been such a big component of Chinese GDP over the last probably couple of decades. I guess there's been a few questions around how does that affects the go forward situation for China if the property market is sort of structurally impaired.
Yeah, and I think that's what maybe that's the misperception or misinformation on the market. If you look at the large home builders like Vanke or Kohli or Longfor, these are companies that they have massive balance sheets. They're either quasi or they are state controlled or quasi state controlled. Their bonds trade close to par. They trade at 3 to 4% yield to maturity. Their stocks trade at reasonable valuations. They continue to run their businesses. They continue to do well. So it's a really relatively small segment of the market where you have the problem. Now, that's not to say that it's not a problem. It's clearly a problem, but it's not such a large problem that it's going to bring down the entire Chinese economy and the entire Chinese banking system. The other part of the equation is the banking system. The banking system's in really good shape. It's not over levered. It's probably overcapitalized. And so again, any comparison to this being like Lehman or any other housing crisis is just wrong. I mean, we went into Lehman and the housing crisis, and Lehman ended up being almost 30 times levered. Bear Stearns was like 30 times levered. If you look at the off balance sheet leverage, if you look at the leverage upon leverage upon leverage, and you just don't have that in terms of Chinese consumer households. You don't have that much leverage at all. And in fact, the government, as you probably know, I mean, this has been going on for a long time. They've restricted and made it more difficult to buy secondary home prices. So if you buy a second home, you have to put down 30, 40, 50%. So that doesn't sound like, something that's frothy like we witnessed, in places like Miami during 08, 09, or prior to that, where you had basically people buying homes with no money down that turned into subprime loans at double-digit rates. So it's a lot of it's headlines. I think we're in a world where news is questionable and there's a lot of headlines and propaganda. So we do our own work just like we do on the commodities, and we do it on China. Now, it's not to say that everything's great, but the market is pricing in a lot at this point. Sentiment's incredibly negative. Everybody loved China at the end of 2020 and coming into 21 couldn't get enough of it, and now everybody hates it, and we just view that as an opportunity. And the stocks are confirming that. I mean, PDD and these other companies putting up good numbers and rallying off of the relatively low price levels kind of confirm that the fundamentals are coming through.
Yeah. I don't want to, sort of sound too dour, but sort of just trying to play a bit of the devil's advocate here, because some of the broader economic data out of China recently has been pretty weak, maybe lower than expected. Numbers out around sort of factory output, consumer spending, unemployment seems to be rising. Growth's obviously slowing. The PBOC came out with some smallish sort of rate cuts recently. Do you expect more of that sort of stimulus to come through? And is that going to be enough to turn things around? Or it sounds like you think we're already on a sort of turning point regardless, but is that part of the story for China going forward?
Yeah, I mean, I think the July numbers were really weak. The first half continued to decline, especially, around COVID and the COVID lockdown. And then you had supply chain issues, as you have had everywhere else. But we are coming through a bottom here at this point. The benefit is that China has the ability to, they didn't bring rates down to zero as we did in the US and as Europe did. And so they have the ability to ease monetary policy quite a bit from here. They also have the ability to put in fiscal policy, which they didn't do as well. I mean, so they have the tools to do it. I think they're going to be pretty measured. They saw what happened in 08, 09, where they put too much in. And I think the US is going through that now. And the US is going to see the other side of that, where it can be pretty painful after you put in that massive amount of stimulus. And so we expect it to be targeted, more measured. But the consumer seems to be in pretty good shape. If you look at, consumer leverage, if you look at certain areas, there's we own, if you look at our portfolio, we might have 60 stocks overall. We might have 20 in China. So we're looking at a market that literally has between the A shares and the H share and the eight ADRs within our universe, possibly 2,500 stocks. So we're talking about finding 20 good companies and growing themes like solar, like I just looked at a wind company this morning. I mean, this opportunity didn't exist 4 years ago because it didn't have massive demand. You didn't have the Chinese government saying, we want to stop buying oil from Russia, the Middle East. We want to basically produce renewable energy because we can do that by throwing up wind farms on the offshore. So the growth of this company has been just, skyrocketing. And you just haven't seen that. The reason why lithium prices are so strong is because, China's shifting towards EVs. China's shifting, basically they're going to electrify their economy. And so you have fundamental changes there. You also have changes in other businesses, maybe e-commerce, maybe how people are buying. This company Kuaishou that we own in terms of video technology, the TikTok, it's basically a TikTok competitor. I mean, they're killing it. They're doing extremely well. So, I think within China, I mean, Chinese economy is the growth is going to slow over time for sure, because just the law of numbers. But even if it's, growing at 3 to 4%, second largest economy in the world, that's quite a bit of growth. And within that, we should be able to find good opportunities.
Okay, great. So you mentioned ADRs, and there's another point that I wanted to touch on. So I mean, there's obviously been some increasing scrutiny from the SEC on Chinese companies. We've heard about some SOEs potentially voluntarily delisting from the US markets. What is the future for Chinese companies that are listed in the US? And does that sort of have any implications for your exposure in China?
Yeah, I mean, interestingly enough, I mean, they just came to a deal last week where it looks like, the SEC is going to be visiting the Chinese authorities in Hong Kong in September. So now this is, I mean, the market has taken this pretty skeptically, but I think it's a very positive development. I mean, we have advisors, Rice, Hadley, Gates, Manuel, who we talk to every month, and they saw these discussions start to pick up about 4 months ago, maybe 5 months ago, for the first time ever. So the Chinese are very engaged in trying to fix this problem, and kind of that's what I went back to in terms of the news. What you read and what you really have to look at what's happening, as opposed to the propaganda you're reading on the newspapers, or where it's coming from, because there are positive developments. There have been discussions. They will negotiate. I think the same goes for the tariffs. I mean, the Biden administration is looking at eliminating or reducing the tariffs, and that would be another positive development. So I think there are going to be some companies that the Chinese government are not going to basically want to have listed in the US. And some of them too end up being very small. So they trade. There were 5 companies that were delisted that were state-owned companies. All of those companies literally traded, $1 to $2 million a day. So this isn't a company like Alibaba or, PDD, or, I mean, these are very, very small companies. So, I mean, some of it is around sharing information and data, but also some of it is just the market structure. The other aspect of it is that China would like to develop the Hong Kong market. They would like to see more and more companies being listed in Hong Kong, basically being, having direct access to the onshore market, through the Connect. And that's another area that they'd prefer to develop, as opposed to ADR market.
Okay, maybe just one more question on China before we move on, because there's been a few questions on this point as well, just around the sort of regulators in China. Obviously, a few people are still feeling a little bit burnt by some of the sort of unexpected policy changes that we've seen over the last, say, 12 months that have had some pretty deep impacts in the tech sector, education, property, etc. Where are we in that policy cycle now? And, are you expecting that there's maybe further changes coming, or maybe a quieter period ahead?
Yeah, I mean, we, as I mentioned before, so when Ant Financial happened, we took down Alibaba, but we also took down China. We went basically almost 10% underweight, at the beginning of 2021. So we were very negative. We were skeptical. We thought it would last for quite some time, but at this point, there's been quite a while since we've seen a wave of regulation or new regulation come out. In fact, most companies have been dealing with the government, changing their business policies, possibly paying fines, and you're seeing that kind of work out. So I would say we're through it. I think you're probably going to see more positive developments there than negative, because I think that the regulators and the government realize that they need the public sector. I mean, the public sector still controls and drives 2/3 of the growth in terms of the job markets and whatnot. So I think that will change, and you'll see that change more and more, especially as we move past the party meetings and into next year.
Okay, great. Maybe if we change tack a little bit and just move to some of the geopolitics that are going on. Start with Russia, Ukraine. Any updated views on the conflicts there? Is there an end in sight? How are you currently seeing the situation?
Yeah, so I mean, unfortunately, in talking to our advisors, Rice, Hadley, Gates, Manuel, they don't see any end to that conflict. We could see, because of the energy crisis in Europe, we could see them kind of do a deal that slows down, the military activity there. But it's pretty clear that Putin wants to own or control all of Ukraine. I mean, that's quite obvious, I think. But he might basically slow that down, one, to kind of lock in these high gas prices. Two, if you could do that on an extended period, length, that would be really positive. Also, both sides have had a difficult time. I mean, the military operation run by Russia has been largely criticized. It's been somewhat of a disaster. The initial phase was a disaster, complete disaster. It's been going slow, much slower than before. He is getting domestic pushback, so there would be a reason to kind of slow it down and regroup. So that could be a possibility. And actually the markets, especially the European markets and any market around there, would take that pretty positively. But I think longer term, that conflict there is not going away anytime soon.
Right. I thought we were done with China, but just a question here regarding Pelosi's visit to Taiwan. Do you expect that there's more to come out of the China-Taiwan US situation, or is this just a sort of a flash in the pan?
No, I think, it's not going away. I mean, that's for sure. So the question is it going to result in a direct conflict anytime soon? And I think that's probably not going to happen either. I mean, when we talk to, some of our advisors, they don't see that happening. So, this trip by Pelosi is likely, was a vanity type of trip where she's probably going to be voted out of the Speaker of the House position, in November. And this is her last hurrah. So she can go down in the history books of saying she visited Taiwan. But, we don't know how that's going to end, and we don't know when it's going to end. So when we think about that and our time frame for markets, if you look over the next 2, 3, 4 years, are we likely to have a Ukraine, Russia situation between Korea, Taiwan and China? And I think the answer is no. I mean, from what we talk to, China's not ready for it. They don't have the military capability. It would be one of the largest or the largest amphibious invasion since D-Day. I mean, this is a massive operation. If you look at Taiwan has military capabilities. They can fight back. So it would be very, very, very difficult. And if you think about too the disaster to the Chinese economy, the Chinese economy is a global economy. I mean, they export all over the world. So those restrictions that, let's say, Western countries would put on the banking system, put on trade, I mean, it would really collapse the Chinese economy. So I don't know. I mean, I think we're going to, again, be hearing about it for some time, but it's probably going to go ebb and flow in terms of the political cycle. And again, she has these meetings coming up where he has to look strong. Obviously, Biden has to do what he has to do, and the U.S. has finally realized that they are falling behind China, so they need to invest. So a lot of it's the politics around that.
Okay, I've got a sort of broader question here, which is, and I think it's a good one. So just asking, isn't the sort of the developed world really the throttle for emerging market growth? And hence, if the developed world is heading into a recession and a sort of low growth phase, then how does that play through for emerging market growth, and especially for some of the more export oriented countries
Mm.
as China, Brazil, etc.
Now, if you look at, and I think that chart I showed during the early 2000s, where you had basically from 2001 to 08, 09, that was coming off of a very similar growth market that we've just come off of the US, and growth was slow for quite a long period in the US and even in Europe coming off of that. So if you look at, economic growth, largely it's driven around population growth, productivity, and where you have population growth and productivity is in emerging markets. If you look at, with the exception, China obviously has a demographic problem, but let's look at India, look at places like Latin America. You have strong population growth. You have a huge potential to increase disposable income. You also have technology that benefits. And then the other kicker, I think, that really hasn't been with us for some time is the commodity complex. So if you have commodities kind of feeding that economic growth, that ends up really being the driver. And you can look at the IMF forecast for growth, and now the IMF are often very wrong, but they still have a pretty wide spread in terms of emerging market growth to developed market growth for 2023. And that's driven around, what I'm talking about in terms of that demographic opportunity, in terms of, the disposable income growth supported by, productivity.
And maybe just on the commodity front, just wondering how, obviously there's a lot of tightness in energy supply chains at the moment. Energy costs have risen a lot. There's also been flow-on impacts into the soft commodity space. Food prices are obviously a real challenge globally at the moment. How is this sort of impacting some of the smaller emerging and frontier markets that are still at the earlier stages of their sort of maturity cycle? And
yeah, it's tough, and you see, Sri Lanka, and you see, food riots, and we've seen that. Those are kind of one-offs, and they are very, very poor countries that, we don't have exposure to, but it highlights the problem that we have, especially for, food or for soft commodities. One of the differences, though, with soft commodities is the cycles are much shorter, and we've already seen corn, wheat, soy correct. So as you have higher prices, we're not short an abundance of land where we can grow more of all three of those very, very quickly. And so the cycles, it ends up being difficult, but for a relatively short period of time. And then we see kind of the crops come down. So we think, we've been through that. We think probably the worst is over. We haven't seen that come through in places like, India, China, even Brazil, Mexico. You haven't seen those types of crises. So I think they've done pretty well. Some of it has been at the expense of government having to subsidize the costs. So there is a cost to that. But for the smaller markets, it has been difficult. And those are the ones, we are trying to avoid.
Okay. We've also got quite a few questions that have come through regarding the US dollar, the very strong US dollar. I'd also add into that the fact that we've got rising rates in the US. Maybe some thoughts on how that impacts some of those emerging markets where they have large hard currency debt burdens as a starting point, and then maybe from there just your broader thoughts around a rising US dollar environment.
Yeah. The dollar's strong. I mentioned earlier, the dollar's strong against every currency. It's strong against the Aussie dollar. It's even strong against the yen. The BOJ has let the yen go. Europe, for anybody who's traveling there, people say it's dirt cheap. Latin America is incredibly cheap. So we're in a strong dollar environment. The question is, does it get much stronger from here? So I think most of what the impact, has been is in the markets, and that's why emerging markets have suffered over the past 12, to 18 months. That's why the currencies have been hit. That's why Brazil has rates at 13, 14%. So I think, and the equity markets are trading at, 11 times earnings. So the markets have priced in that. The question is, where does it go from here? But at some point, you'll see a shift in the dollar. I mean, we have a very large current account deficit in the U.S. U.S. companies are international. They are going to be hurt by the strong dollar, which is going to weigh on S&P earnings. You also have fiscal pressure in the U.S. If you look at the fiscal deficits that we've been running. So, we think we're, really probably close to the dollar peaking out. That's something very difficult to time, obviously, and markets right now being volatile and being in August, September, which are typical volatile periods, that's tough to time. But we have seen evidence that the U.S. economy is slowing dramatically. We saw basically housing has started to roll over, home prices have started to roll over, consumer confidence is at a 40-year low. So there's a whole list of reasons why the economic growth in the U.S. should slow. We still had a good job number last month, though. So at this point, the job market seems like it's intact. Yet every day we see more and more companies announcing layoffs. So I think that's something to watch very closely. Any of the indicators in terms of jobs, in terms of looking at the economic strength of the U.S. And the Fed, they were obviously late to tighten monetary policy, very late. They kept monetary policy way too easy, and they want to look very, very hawkish. So if you look at Jackson Hole, they're all saying, yeah, we're going to keep rates are going up to 4 or 5%. We're going to keep them there forever. We'll see about that when, the economic growth is much, much lower and inflation starts to roll over. So, we had a shock with COVID, and then we had another shock basically with Russia, Ukraine. And so I think if we didn't have Russia, Ukraine, they probably would have been on a trajectory for inflation to roll over. But that was another energy shock and supply chain shock that really pushed inflation to much, much higher levels. So they're going to be slow, though. So I think they will be slow, but at some point you'll start to see stability in U.S. rates, and it's not going to be north of 4%. I mean, our view is that they probably at the most peak around 4%, and then eventually start to come down.
Right. We're sort of running over our allotted time, but I'll squeeze in one more question because there's quite a specific one that's come through just regarding Petrobras. Sounds like they've paid a very large dividend recently. I missed that, but yeah, thoughts on Petrobras.
We do have a position in Petrobras. They are paying out a huge dividend based on the policies of the current administration, which is Bolsonaro. Just to put it in context, a few years ago, they were spending $40 billion a year on CapEx. This year, they'll spend 10. So they're basically not investing, and they're paying out as much cash as possible. Lula, who, as you know, is running to become reelected, has said that he wants to use state-owned companies to basically fund social spending. So the question is, what's the dividend policy after Lula comes into office? Does he cut the dividend? Is it sustainable? And we continue to analyze that. We think it could be sustainable, not at this level, but where somewhere in between, where he does keep a higher dividend policy, but yet they also end up paying more out to the government in terms of basically ineffectively through building things like refineries. So you still get kind of growth, but you might not get it back to yourselves. You'll still get growth through expansion of the plant and equipment, which for Lula means jobs.
Awesome. All right. Well, thanks, John. Or maybe if you want to just I'll leave it to you if you had any closing comments, maybe around how the portfolio is positioned or outlook in general. I know you touched on valuations already during your presentation, but I don't know if you had any comments around the earnings growth that you're expecting in the portfolio or anything of that nature.
Yeah, I mean, so if you look at the upside of the portfolio, we have, which is upside to price target, we have about 48%, which is high. It's high by historical standards. As I mentioned, the portfolio trades at 10, 11 times earnings, maybe 11-ish. So it's cheap. I mean, it's very cheap, and we're on par with the index, which historically, we've been like a little bit above in terms of the PE. But when we look at the bottom up, the earnings forecast that we have in terms of our portfolio companies, it's approaching 30%, which is huge. And the interesting thing that we're seeing is companies like PDD, Mercado Libre, they're coming through with these very, very high earnings growth. So we're seeing the numbers coming through, kind of substantiating the upside in terms of the earnings upside. So I think it looks good. I mean, I think the caveat would be Fed policy, as you know. I mean, if the Fed goes crazy and they really want to push the U.S. into a recession, that's a big risk. At this point, I kind of think the China risk is off the table. I mean, we're seeing more and more evidence to support kind of the bottoming of China and the fact that, they will not continue to slow in terms of growth and, which would hurt, obviously, the broader housing market. So I think, that was probably a pretty big risk, maybe even 2 months ago, which I think we feel better about. And even on back to the Fed, I mean, Powell did say at the last Fed meeting that they're close to neutral. So there's a big debate going on at the Fed. So it's not that they're 100% going towards 5, 6, 7%. But beyond that, then, it's kind of investors realizing, okay, where's the best risk reward right now? We just went through a massive growth investment phase where, investing in private equity, venture capital, you have any type of internet related company, SaaS related company, you had automation and AI and whatnot. And I think the next growth phase is going to look a lot different. It's going to be focused on energy transition, which is basically the world thinking about how they power themselves, which could even be nuclear, as well as wind and hydro and whatnot. The other focus and driver is going to be not only infrastructure, but also defense and security, which that ends up being very commodity driven. So if you're building, nuclear submarines or battleships, whether you're in Europe, Australia, wherever, China, that's going to require more and more commodity and more commodity intense. And then from the emerging market standpoint, it's the recovery from COVID that they've never really had. I mean, they haven't had a full recovery from COVID. So we have this GDP gap that, as I showed earlier, which will be closed over time. And I mean, just think about China. If they were to start to open up their borders for people traveling, I mean, we all know that that's a huge, has a huge impact on certain markets and certain industries. So we actually are pretty favorable about it. And I think even the China-US relationship, I mean, the fact that they are talking in terms of the accounting issue, the fact that the Biden administration is contemplating the tariffs, once we get beyond the midterm elections, you could see more positive developments there.
Great. Well,
thank you. Thanks,
a really
Luke.
interesting update. Really appreciate your time, John. Thanks to everyone for dialing in. We'll send around a copy of the slides to everyone post the call, and a replay will also be made available. And yeah, apologies for the questions we didn't get to. We'll come back to you individually. But yeah, please reach out to anyone on the screen there if you have further questions or would like to get in touch. Thanks again, John, and look forward to seeing you in Australia again soon.
Great. Thank you, everyone.